Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, February 14th. Happy Valentine's, everyone. We got a lot to kind of cover today, so I'm just going to kind of jump right into it. We'll start off with the initial jobless claims we get every Thursday. So last week we had 234, we got the report for the previous week at 234,000 people applying for unemployment. Forecast was supposed to be in the 220s at 225,000, and it actually went up a little bit, 239,000. Now, with this sudden surge, now this could be again, this could be still part of the holiday season. You know, the seasonal jobs that we get during the holiday season. This could be still part of that, or even part of the initial job or the government shutdown. But this is going to pose the question to a lot of investors: is that have we seen has initial jobless claims bottomed out? So are we going to start seeing this rise? So when you think about when we look at these are kind of a prelude to what we would normally see for a what would lead the economy into recession. Because if we start seeing people or companies start laying people off, that usually leads into recession. And this is why this is an important data to be watching here. And we're going to keep obviously a very close eye on this to see if this is going up. And then of course we want to watch the job numbers, see if the unemployment rate starts ticking upwards as well. So again, this is something we'll keep our eyes on. It's going to pose that question, and that's going to be something that's going to be on investors' minds every week when they see these initial jobless claims. See if this is just again a fluke, or if it's going to mellow out and kind of improve again, or how it's going to see where we end up. So again, this is going to be something we'll keep our eyes on going forward. Also, we got retail sales for the month of December. So in November, we had a nice little pickup at 0.1%. Forecast is supposed to be basically unchanged for December, and it was very disappointing, obviously, at a drop of 1.2%. Now, when you take out the big ticket items of autos, we had in November, the month over it went up 0.2%. So forecast was supposed to drop 0.1% in December, and actually even was much worse. It came in much lower at 1.8%. So this is kind of very disappointing in the sense that, this is the holidays. December should be a very good month for retail sales, but if anything, it actually was worse. So this is something, again, these two things are kind of affecting the markets. As you'll see here coming up in the stock market, it's affecting the markets, taking the center stage here. And then also we got the producer price index. This is inflation on the wholesale level here. Now, this doesn't get a lot of respect because it's not exactly, even though sometimes inflation rises on the wholesale side, but and those costs don't always get passed on to the consumer. What we primarily will look at is the CPI, which we got yesterday, and the PCE report, which is the PCE is most important primarily because that's what the Fed more favors that one as a report. But we do kind of like to look at the PPI because it gives us indication as to where things are moving towards, and it could potentially move over to the consumer side. So as you can see here, in December it dropped 0.2%. Forecast for January is supposed to go up 0.1%. It actually went down 0.1%. So it continued its trend of a downward trend here. Now when you take out food and energy, we get what they call the Core PPI. And this is kind of our control group here. Now with this one we had basically was unchanged in December. In January, we thought it would go up 0.2%, and it actually increased by 0.3%. Now, I'm going to go over year on these ones. On the headline here, the year over year, it actually dropped from 2.5% down to 2%. And then the core, it dropped a little bit actually. It dropped from 2.7 down to 2.6% year over year. And the Fed likes to keep its inflation gauge around 2%. It's more healthy at 2%. So as you can see, these are a bit higher in that edge there. And of course, the core, again, is what we kind of look at because we can't really, there's no control over those variables of food and energy. So this is why they look primarily at the core when they look at these numbers here. We got the business inventories, last but not least. In December, it grew by 0.6%, but in January, it declined by 0.1%. Stock market's down. Like I said, it's taken for the last couple of days. We're kind of taking the optimism. We were getting a lot of optimism with the U.S.-China trade here, and now we got the higher ups discussing the negotiations starting today. And then it looks like President Bush is about, or sorry, Bush is, I'm way in the past. President Trump is about to sign the border security legislation. So that looks like it's moving forward and will avert a partial government shutdown that we faced last month. And so these have been what's kind of boosting the markets, but with those other signs like the initial jobless claims, the retail sales coming in very disappointing, that's kind of driving the stock market. It's taking center stage into what's driving the stock market down. We do got some more Fed speak going on today. It hasn't done much effect, hasn't had much effect because they've been kind of keeping that toe where they're doing a wait and see approach in terms of the rate movements. We won't see rate hikes because some believe that there may not be. The next rate movement might be actually lower. They might cut rates. So that's why we're not really seeing rate hikes now. So let's see how this is affecting the bond market. Bond market, as you saw yesterday, we did close below the 25-day moving average, but today we are up. We are up about 14 basis points so far, and that will lead us to better pricing today. Yesterday, with that loss, our pricing was a little worse, but today we kind of gained that back and above the 25-day moving average, as you can see here, and will give us a better pricing today as a result of that. As you can see here with the 10-year Treasury, we're right up against that 25-day moving average. It held still, and it pushed it down further. So yes, it stopped in around 2.71. Today we're down to about 2.66 right now on the Treasury yields, which is helping lessening the pressure on mortgage-backed securities and helping interest rates decline. So that wraps it up for the day. I hope you guys have a great Valentine's Day. I hope you guys enjoy yourselves. Be safe, and if you guys want to get any of the latest, I'll post on Twitter here. You can follow me at Mike Bjork. Otherwise, you guys have a great rest of your day again, and thanks for watching. We'll see you guys tomorrow. Bye-bye.